Welcome to The Explainer. So, on February 12th, something really strange happened in the global markets. It's like they just fractured. While the US market took a serious tumble, South Korea's market absolutely soared to an all-time high. Today, we're going to decode these completely conflicting signals to figure out what is really going on with the world's economy.
Okay, so here's the puzzle in plain numbers. Take a look at this. In the US, you've got the S&P 500 dropping a pretty hefty 1.5%. But then you jump across the Atlantic, and France's CAC 40 actually managed to eke out a small gain. And then there's South Korea. The Kospi didn't just go up. It skyrocketed over 3% to a record high. I mean, three different markets, three completely different stories. What is going on?
So, this divergence, this split, is really the central mystery we're trying to solve today. What invisible forces are at play here, pulling the global markets in such opposite directions? Let's start digging in. First up, let's tackle the United States. To really get our heads around why the market fell so hard, we're going to look at it from 5 different angles, 5 different theories. Each one tells a crucial part of the story.
Okay, so first, from the viewpoint of the Austrian School of Economics, today's strong jobs report, that wasn't good news. It was actually bad news. Why? Well, because it's a huge sign that the era of super cheap money we saw in 2025 is officially done. You know, all that easy credit created what you could call zombie companies, businesses that were only really surviving because money was free. Now that interest rates are staying high, their life support just got unplugged. The economist Saifedean Ammous just nails it with this quote. The interest rate is the price of time. And with the Federal Reserve holding rates firm, time just got a whole lot more expensive. So companies that haven't been using their time wisely, companies like IBM, which tanked 6.5% today, well, they're finally getting the bill. Next up, we have this really fascinating idea from Professor Gunter Dueck. He argues that a lot of these big tech giants became, well, too perfect, too efficient. He calls it homo economicus. They mastered the old game, pouring money into things like share buybacks instead of taking risks on new research. But now, in this new age of AI, that rigid, perfect efficiency has become a massive weakness. They're just too optimized to be able to adapt. And you can see the consequences right here. The market is starting to punish companies that don't have that creative slack, that extra room for innovation. It's shifting its focus. It's no longer about just being the most efficient machine. It's about being the most adaptable organism that can actually survive and thrive as the rules of the game change. Third reason, let's just talk about price. The investor Ken Fisher has this great phrase. He calls the market the great humiliator. And here's why. U.S. stocks recently hit a valuation that was in the 98th percentile of their entire history. I mean, just think about that. From that kind of altitude, a fall isn't just possible, it's pretty much inevitable. So today might not have been a crash, it was more like gravity just reminding everyone it's still there. Fourth, you can't ignore the human element, right? Social psychology. John Cassie's theory about the madness of crowds fits today like a glove. The crowd saw a strong jobs report and they didn't think, oh great, the economy is strong. No, they thought, oh no, the Fed is never going to cut rates now. And that single thought flipped the entire market's mood from giddy optimism into a cascade of fear. You can literally see it in the VIX, the market's fear gauge, which spiked all the way to 17.65. And finally, let's look at market cycles. Think about it like waves in the ocean. The analyst Edward Dewey discovered that when different big waves, like say the 40-month business cycle and the 18-month policy cycle, when they happen to crest at the exact same moment, you don't just get a big wave, you get a rogue wave. And today, it really looks like a few of those major cycles just converged at once. And here you have it, the combined result of all 5 of those forces hitting at the same time. It is just a sea of red. The tech-heavy NASDAQ and the semiconductor index got hit the worst, both down over 2%. And as you can see from this table, the technical signals are pretty unambiguous. Strong sells right across the board. But, you know, this whole story doesn't end in the US. Because while American markets were in a nosedive, Europe and especially South Korea were on a totally different flight path. So the big question is, why? You know, the key difference really seems to boil down to one critical thing: the quality of a country's economic institutions. As this slide lays out, capital, big money, is flowing towards what we call inclusive systems. You know, places with pro-growth reforms, a focus on innovation.
And at the same time, it's flowing away from extractive systems that are bogged down by barriers and decay. And South Korea is the absolute poster child for this right now. The KSPI didn't just have a good day, it smashed its all-time record. And the reason is pretty simple. They're pushing through major reforms, like the Corporate Value Up program, that are basically sending a giant signal to the world that Korea is serious about growth. And believe me, global capital is paying attention. Okay, so we've spent some time digging into the why of what happened today. Now let's switch gears and talk about what's next. For that, we're firing up our quantitative models to see where these powerful trends might be heading. We use a model called GARCH VECM. Now I know, don't worry about the name, it sounds incredibly complicated. Just think of it like a very sophisticated weather forecast for the market. It doesn't just predict if the price will go up or down, it also tries to predict how strong the storm will be, that's the volatility, and how long it's likely to last.
So what's the forecast telling us? Well, it looks like this great divergence is set to continue. The model is projecting more pain ahead for U.S. tech, with the semiconductor index possibly dropping another 6.6%. But on the flip side, it sees the incredible rally in South Korea's Kospi continuing, with a potential climb of nearly another 6% to 5,850.
So, with all of this data and a forecast in hand, how do you actually translate this analysis into a concrete, data-driven strategy for a portfolio? Well, this strategy that emerges seems to break down into 3 clear actions. First, you hedge America. Given the high valuations and those cyclical headwinds, it makes sense to get defensive. Second, you lean into Korea. Those institutional reforms suggest there's a real structural shift happening there. And third, you build what we're calling a slack portfolio, favoring companies, especially in Europe, that have that innovative R&D slack we talked about, which makes them much more resilient to whatever comes next. So, I think the most crucial thing to remember through all this volatility brings us right back to where we started with Ken Fisher. The market is the great humiliator. It has a way of humbling even the most rock-solid consensus. And today's incredible divergence is just a powerful reminder of that fact. And that really leaves us with one final big question for you to think about. Today's market action created a massive fork in the road for global capital. One path seems to be punishing the rigid and overconfident, and the other is rewarding the adaptive and innovative. So you have to ask yourself, which one of those paths is your portfolio built for?